All right, it looks like we're on the 12 p.m. mark, so we're gonna get started. Well, hello everyone. Welcome to the Business Fight session. I hope everyone is having a wonderful Wednesday so far, and I'm very excited to see everyone join us for this amazing session. It's a little bit different from our fireside chat, but it's gonna be a very good one. So for those of you who may not know, my name is Brian Lay, and I am the marketing intern here at HanaHaus Newport Beach. This will actually be my last time introducing this session to you all as my internship comes to an end, but Business Bites will continue to thrive, and I'm very excited to see where the event will grow in the future. So as a background, Business Bites is a collaboration between HanaHaus and Honest Access. Onyx Access is an innovation consulting firm, and HanaHaus is a flexible co-working space located in two locations, Palo Alto and Newport Beach. Our space is currently closed due to the pandemic, but we continue to operate and working towards a potential reopening date in the future. So keep in touch by following our social channels and our newsletter. As for now, we'll continue to host these amazing virtual event sessions, and you can see them all at hanahaus.com/events, or again, follow both of our social media channels. Some housekeeping items. We encourage you all to use the chat box down below to ask any questions and engage with each other. So as a quick starter, I want everyone to go down to the chat box, and we'll love to see where everyone is tuning in from. So for me, I am tuning in from Irvine, California, and it's a very sunny day today. So very excited for that. As a reminder, the session is going to be recorded and posted onto our HanaHaus YouTube channel, as well as Honest Access YouTube channel, and sent via email within the next week as soon as we have our next Business Bite session. And we'll also provide a survey link at the end of the session for any feedback that you may have to improve our future Business Bites. And with all that being said, I would like to hand it over to Kelly from Honest Access as not today's moderator, but as today's speaker and presenter, and encourage you to all ask a lot of questions, engage, have a lot of fun, and thank you again, and enjoy our May Business Bites session.
Brian, I just want to start off by saying thank you. It's been such a pleasure having you introduce the Business Bites series. We've come a long way since we launched during our pandemic kickoff last year, and I'm absolutely excited to see where your career takes you in the future. So thanks so much for your participation. And thank you to everybody who's joining in for this slightly different format of our Business Bites session. If you're wondering about the departure from our standard fireside chat, I'll share that it came from the survey responses and the interest of participants like you who have, following attending events where we've talked about resilience and change and the role of innovation in the workforce and the future of the workforce, have consistently asked questions about launching business, about how to fund businesses, about when's the right time and how to know how to fund a business and what the right structure is. So I'm Kelly O'Connell, as Brian said, and I'm really excited to take off my moderator hat and to speak to you today a bit about the role that funding plays in this business launch process, and to talk about the types of funding models and the impact they have on organizational scale. A few items to consider as we're having this conversation. First, this is a conversational exploration of funding. So I see that you're logging in, and some of you are familiar with the Business Bite series. We'll certainly be having a Q&A at the end, but do ask your questions. I'm really excited to make sure that all of you get to be part of this conversation. So if you're joining today and you have questions, let me know what they are in the chat. And if you're here as a founder that's got experience, I'll certainly give you the opportunity to be able to weigh in during the chat. So share, we're better as a community. The other element that I do want to share, and this is an inclusive environment. The HanaHaus series is designed as a free educational community engagement. we have typically speakers who volunteer their time and participate. And I'm a big believer that the more we can educate people about the funding process for launching business, the more diversity we're going to see and the more underrepresented voices we're going to see, creating innovative companies for the future that have the impact and opportunity to not only create wealth for those founders, but also to be able to create substantial change in our economy at large. And so I'm really excited to be able to share the information that I have about the venture funding ecosystem, but not just venture. And one of the things that we're going to really talk about today is the diversity of funding models itself. Venture isn't the only path, and understanding the timing and options available to you as a founder can really help to create opportunity for your company as you scale. Brian shared some housekeeping up front. I'm going to share a couple of additional housekeeping elements here. One, I am not a financial advisor or an attorney. So the information that I'm sharing with you today comes from my professional experience. It comes from my experience, early career in mergers and acquisitions. And it comes from my experience as a consultant and advisor to early stage startups, several of which have gone on to be unicorns, and to helping enterprise organizations, many among the Fortune 500, create entrepreneurs within their organizations and create venture arms of their organizations. And so if you are approaching this as a founder seeking funding, I can't encourage you enough to seek financial advisors who are going to support and advise your specific circumstances, and attorneys who truly understand the venture scale landscape and not just seeking out information from the web. Because the more specific you can create information for your experience, the better positioned you're going to be. Now that legalese is out of the way, I really want to talk to you about the landscape in general and about why I'm passionate about this conversation. So I mentioned my early career was in mergers and acquisitions. I worked for a global bank, and I helped as that bank acquired other banks. And in that process, I learned about the role that structure plays in an organization's opportunity for success, and the role that structure plays in a founder's opportunity to create generational wealth or to have a moderate exit from an organization. And the early funding and the understanding of structure in that funding really goes a long way to determine later round funding structure. And so that's one element that I'll be touching on today. It comes from that passion that I have around really helping founders see their ideas into fruition. The other element of this is that there really is an equity gap in who has access to launching business. So as we just look back at the most recent 2 years, women and underrepresented founders make up less than 5% of venture funding that occurred in 2019. Women make up less than 3%. Underrepresented founders make up less than 4% of the overall funding landscape. And so if we can increase the funding opportunity by increasing education and helping founders to have access to knowing the paths to take to secure funding, we can increase the diversity of companies that are being created. And I believe, particularly around impact companies, this is going to create benefit for the collective world. And that's something I'm really passionate about. That said, you're probably wondering what specifically we're going to be talking about today. So I'm hoping to structure today's conversation around 4 key areas. We'll talk a little bit about market landscape. We'll talk about entity structure, how to form the company. We'll talk about funding 101. And then we'll talk a little bit about the role that vision and planning and structure play on your long-term success. A reality that many startup founders have to face is that even those founders who are able to secure funding, many of them don't exit to a successful scaled exit. Now, for many founders, and I've had the opportunity to coach and advise many founders throughout my career, many founders approach with an idea that they have a great market idea that they want to solve. And it's often coming from a very personal place. It's an experience that they've seen a problem and they want to fix it. They see a market opportunity. And many founders think, I'm going to fix this problem and I'm going to exit to Wall Street. But exiting to Wall Street is just one exit path. So we're going to start with market landscape, and we're going to talk a little bit about why I think it's important to understand that most founders, even those who do secure funding, exit successfully to a path other than Wall Street. And so really thinking about your organization and thinking about how you want to structure in the market landscape will really help you to refine your energy. I think one of the biggest elements to think about, and I'm curious, I'm going to pause for a second and I'm going to ask those of you who are currently live with us, are you, anybody here, are you a startup founder or thinking about being a startup founder? And you can either write me as a private message or write back everybody. But for those of you who came here who are startup founders, I'm curious how many of you are startup founders. So feel free to just write me back in the chat. And if you are a startup founder, I'm very curious at what phase you are in the process. So if you're a startup founder, are you actively seeking funding? And have you thought about this? What brought you here today? So those are two questions. If you're at home, I want you to think about that. And as I have you responding back and I'm reading that, I'm going to talk a little bit about the market landscape. And early stage founders, I hear often three questions from early stage founders who haven't registered their idea yet. And they are, what are the common business entities? How should I structure my company? And what should that look like? And where should I register my business? You know, I've heard a lot of companies are registered in Vegas and a lot of companies are registered in Delaware. What does that mean? Where should I register and why? And then when should I register my business? When is it too early? When is it too late? What do I need to know before I register? And so as we think about this market landscape, we're going to think a little bit about the registration process. Before I go too far, I'm going to share for any of you who may be international on the line that I come from a very North American perspective to this conversation. So my background, I was born and raised in the United States, and my background and experience has largely been working with companies, even if they're global. I've been working with their US or their Canadian operations. And so as we're having this conversation, just know that I am coming at it from a conversational lens of the United States. The other caveat that I'd like to call out is that I'm really having this conversation around for-profit business entities, though there is a growing space of structure, impact companies that are B Corp and impact companies that are nonprofit. And I will touch on those lightly over the course of this conversation. But the conversation around today is about for-profit venture scale business ideas and how to register. So thank you for those of you who are engaging in the chat. I'm really appreciating it. So really looking at these conversational questions and thinking about the market landscape, it may feel really complex and crowded, right? There are 9 common structures that people talk about in business entity from a legal perspective, but they really come down to 4 common entity types: the sole proprietorship, the partnership, the limited liability corporation, and the corporation. There are labels, there are sort of nuances of each of these structures, but these are the 4 common legal structures. And each of these structure types has advantages and disadvantages. So the sole proprietorship is one of the easiest structures to create. The sole proprietorship allows an individual to fairly easily stand up an entity. This is often the case for gig workers, people who are using services like Upwork or Fiverr, or organization individuals who are participating maybe as an Uber driver. So your sole proprietorship has the kind of lowest barrier to market entry and the least expense to market entry, but it also has the least protections in terms of the ability to scale. A partnership basically creates relationships between individuals, and it defines the structure. And this is often seen in trust organizations. And so there's a relationship between the entities. A limited liability corporation adds a layer of protection between the individuals and how they're managing their tax filing and the corporate structure. So this is sort of the beginning of a scaled entity. But it creates a legal relationship between the company and those people participating in the company. And it allows for this concept of equity or some share or distribution of ownership, which may be equal or maybe disparate, depending on the types of structure. And then corporations allow for a separation between the legal entity, which becomes its own taxable entity with its own opportunities, versus the individuals. And so even founders who are creating corporations essentially become W-2 employees of the corporation that they're working for. So for those of you who are founders here who are forming and structuring corporations, the goal is actually to get back in-house, to be an employee of the corporation that you're starting up. So these legal structures are really just common ways to talk about the way to design your company. Choosing the right structure depends on your business goals. And this is the first really important concept of really thinking as a visionary startup founder. You want to think not just about the problem you're solving and how you're solving it, but you also want to think down the road about how you're funding the problem that you're solving. And you want to think down the road about what are your intentions for the company. Do you plan on selling to another company? Do you plan on leaving the company that you're creating to the employees of the company in a co-op structure? Do you plan on leaving this as part of a generational package? In the case of a family office, is this something that you plan on exiting to public market? All of these decisions are based on your total addressable market. So who can you serve and who are you trying to reach? What the competitive landscape looks like for the company that you're trying to build. So there are industries that you're going to approach where there are sort of predetermined right structures that make more sense. If you are developing an individual gig service where you're providing user experience services to other companies, a sole proprietorship probably makes quite a bit of sense for you, at least as you're getting started. But if you're trying to build a AI tech company and you know that to be competitive, you're going to need significant funding in order to be able to go to market and achieve your goals, then you probably want to create a structure at the outset that allows for you to be able to set up and structure equity shares in your company. So as a founder, really thinking about your concept, how you plan to get to market. But one of my favorite terms is fail forward in the startup space. Even if you make a mistake as you were thinking about this concepting, it's not permanent. You have opportunities to restructure. There are systems in place to refile. So you want to balance between being systematic and thoughtful in your approach to the funding structure and not creating barriers that prevent you from being able to go to market and test your idea. So don't allow the structure to prevent you from trying out and taking a chance on a market idea if you're excited and you're truly passionate about creating it. As you move through the process, you can redesign your structure. The thing is that if you're thoughtful about it up front, it will make it much easier for you to have conversations with potential investors. It will make it much easier for you to have conversations with potential partners that are going to help support your vision. So being thoughtful up front can reduce the rework burden. And that's really why I start off the conversation here. So for those of you who are asking some questions about where to register, we're going to talk about that a little bit more based on structure type. But one of the things I think is really important to remember is that where you register is directly tied to your vision for your company. So the only reason that organizations register in a place like Delaware, or one of the most common reasons that organizations register in a place like Delaware when they're a corporation, is because Delaware has a corporate structure for business entities that's been tested. It's easy to access. It's familiar to most of the people and funding systems that have a chance to be able to invest in venture scale companies. And so it's not something that will create a barrier for funding. And that's the measure that I would like you to think about as you're thinking about funding, as you're thinking about where to spend your energy. Don't get bogged down in the details of this. Be thoughtful, but I want you to use the measure of, does my decision create a barrier for getting people on board and engaged in helping me see my vision through to scale? And that's going to be a really nice measuring stick for you as you think about your business. So as a startup founder, if you know that your goal is to go to venture partners to fund your organization, then starting as a corporation from the outset is going to be really helpful. When you do that is going to be really determined based on how competitive the landscape is, how quickly you can go to market, and a number of other factors. So let's continue the conversation. Thanks so much for the questions that are coming in chat. I'm definitely going to be covering them as we talk along. But for those of you who are here and engaged in not chatting with me yet, I'd love for any of you to tell me on a 0 to 10, and that first topic we just talked about, market landscape, with 0 being, Kelly, I have no idea what you're talking about. I've never heard this stuff before. And 10 being, oh, this is redundant. I've heard this a lot. If you could just put in a 0 to 10 score, just so I know sort of the level of understanding of the startup space of our audience, that would be really helpful in me customizing the answers that I'm sharing with all of you. So 0 to 10, with 0 being, well, that first market landscape topic was all brand new, and 10 being that market landscape topic was really redundant for me. Just help me get a measuring stick. And as we do that, I'm going to start to talk about the next topic here, which is really thinking about structure. So as you're thinking about the organization, and this is one of the ones that I most commonly receive from startup founders. So how do we design this right from the outset? What are the relationships between partners? How do I determine what the right business model is? How do I assign shares for my organization? You know, these are really important questions, and they are questions that really depend on the type of business you're starting. So the first thing to know is that if you're starting a real estate trust, my answer to you on what are the relationships between partners looks very different than if you're starting a software company, or you're starting a SaaS payments company, or you're starting a crypto company. So as you're thinking about the company entity, Be wary of anybody who tells you that there's a fixed right structure to have between partners. And instead, really spend your time thinking about what are the common structures for the type of company that I want to build. And then we could spend all day just talking about how to structure the right relationships between partners. This is a conversation that we could really spend a tremendous amount of time in. One of the things that I think is really important for startup founders to recognize is many startup founders are creating this idea as a side hustle while they're already doing something else, which means the already limited amount of energy you have to spend on something will be further reduced by how much time and energy you spend on misdirected information. And you can go down a lot of rabbit holes in Google. And so really refine your lens based around the type of entity you're trying to create. That's why we talk about market landscape. If you're trying to start a restaurant, you're going to spend time looking at how other restaurants are structured. If you're trying to create a new plant-based venture company around plant-based food tech, then take a look at how other plant-based food tech companies are structured. Take a look at Crunchbase and look at how their organizations are structuring. But most importantly, get really clear on what's the type of company that you're trying to create. What are the types of funding models that companies that have been successful in your industry have received in the past? And then educate yourself around that element. So in other words, if you're trying to create a franchise restaurant, don't spend your time looking at funding models in the venture space. Spend your time looking at funding models that are revenue-based funding models or bank-based funding models. We're going to talk more about that in just a few minutes. So how you determine your funding model has a lot to do with the problem that you're solving and the right business structure for the problem that you're trying to solve. And then how do you assign shares? Well, whether or not you assign shares is the very first question. So your funding model will determine if you have shares. I am the executive vice president for On Its Axis. As an example, On Its Axis is an innovation consulting firm. We've been in business since 2009. On Its Axis is a bootstrapped company. And in just a moment, I'm going to talk about what that means. But On Its Axis as a bootstrapped company doesn't have shares that we're distributing because we haven't sought venture funding. And so assigning shares isn't part of the energy we have to spend as part of our internal conversation today. So what I mean by this is you want to think about the questions you have to answer based on your structure. So what are the founder relationships? This piece is a critical conversation point. The relationships between the founders, regardless of your structure type, is going to be essential. Even if you are a sole proprietorship, you want to think about the relationship as a sole proprietor between the work that you're doing and how you're receiving payment for that work. So I gave an example of a marketing professional setting up a business as a sole proprietor. So I said a user experience specialist or a UI specialist setting up a sole proprietorship. You don't necessarily think about a founder relationship in that instance, but in my experience working with companies, many people's path to entrepreneurship takes them from the role of an employee to the role of a contractor. And then from the role of a contractor to the role of an independent consultant, where they stand up a DBA and a sole proprietorship. In this instance, there's often the conversation of, am I an independent contractor, or is there a co-employment concern? Am I an employee? So even if you're setting up a sole proprietorship, you should be thoughtful about this founder construct. thinking about founder relationships as a venture scale founder is really important. One of sort of the most hallmark examples of this is the early days of Facebook. There are many movies and many stories about the early founder experience of Facebook. And so if you're thinking about founder relationships and why this is important, that is a great cautionary tale of the value of getting very clear very early about founder relationships. So if you're going into business with founders, my number one bit of advice that I can provide to all of you is that clarity is key. It is okay for founders to have different levels of engagement with a company. You may be a technical founder that's working on the product 40 hours a week. And you may have somebody who 10 hours a week is just engaged around securing funding for your company. Your team can weigh out the value of that. You can determine how much of an equity split there is between those founders. But the importance is that if you're building a venture scale company, your founder structure needs to be legally documented between the founders. You need to be thoughtful about how you're engaging with each other, and you want to document that process. In other words, get very clear with each other. If you're not sure about how, one of the tips that I'm going to provide to all of you is that there are a number of resources for venture scale companies available. I recently completed a program. Even with the experience that I have in this space, I'm a big believer in education. And I recently completed a program that I highly recommend. And I'll, at the end of this conversation, add in the links to the program. But it's a KF Techstars program by Brad Feld, who's somebody I respect tremendously. He's a venture leader who does a tremendous amount of give back and educational work, far more expert on the subject matter than I am. If you're a venture scale founder, I can't emphasize it's a free program that's available. It was really terrific. And it provides some fundamentals that venture founders can really understand around this founder relationship, the documentations, and how to legally create it. So KF Techstars, I'll add the link in the chat at the end of today's conversation and make sure it's available to all of you. But that's a really important piece. You know, as we think about this, I did mention that it's going to be a venture lens, but I'm going to pause because unlike our typical conversation points, today's conversation's been a lot of me talking to you. And so I'm going to take it off of chat for a minute, and I'm going to give those of you who are in the audience an opportunity to ask some questions about the first two subjects that we've covered. Is there anybody in our audience? Just raise your hand if you're interested, and I'll have Brian go ahead and call on you. Anybody with a question? Feel free to raise your hands.
You can also put in the chat if you like. Raise your hand in the chat.
Thanks to everybody, and thank you all to sharing your business entity level of expertise. Is very helpful for me to know the level of expertise on today's call. So I'll be giving lots of opportunity for you to weigh in. And as Brian mentioned, feel free to write your questions in the chat as well. So thank you so much. Venture capital. This is the one that everybody defaults to. So when we think about funding, the top three questions that I receive from this Business Bite series and more broadly are, when should I seek funding, Kelly? I've got an idea. At what point should I go out and seek funding? The second question is, how do I get funded? How do I know who to connect with? And then the third question that I hear is, how much funding do I seek? But before we talk about when to seek funding, I think it's really important to take a moment to acknowledge that venture funding is not the only path. In fact, venture funding is not the best path for many types of businesses. So there are several types of businesses that we've talked about in today's conversation. There are countless businesses being formed in the United States every single day. There are over 16 million businesses in the US that are in operation, and many of those businesses never seek venture capital. So we're going to take just a moment to talk about other types of funding, because in today's landscape, we also have an increasing opportunity to access diverse types of funding. So today, bootstrapping is one I mentioned. Bootstrapping a company is when you're taking personal assets, or sometimes personal and family assets, to grow and scale a company. Crowdfunding or tokenization, two types of funding structure, are when you have a business idea and you go out to the general market and you offer up an opportunity for other people to support your organization, typically through a social platform, now through a combination of social platforms and crypto exchanges and a variety of other structures. There's the classic structure, that restaurant example I gave of the bank loan. And there's a growing movement around revenue-based financing. This is particularly true for e-commerce-based companies, SaaS and subscription or platform as a service companies, and a variety of other recurring revenue companies. Community platforms and community companies are another great example where revenue-based funding is a great path. Venture capital, where we'll spend a lot of our time today. And then angel and grant funding. So I mentioned that there's this idea of the nonprofit space. We think of grant funding as exclusively for nonprofits, but grant funding is also available in areas of economic development globally. Grant funding is available for impact projects that solve a greater good. Grant funding is available to underrepresented founders to help seed early stage funding. There are a variety of grant channels that are available, even to for-profit initiatives that serve public benefit. So public benefit corporations often receive grant funding. And then this angel funding, I mentioned Crunchbase as a path for angel funding, but there are many types of angel network and syndicate networks available. University programs offer a combination of angel and grant funding. So hopefully you're seeing these are just the most common types. There are other structures out there, but we would be here all day if I tried to cover all of the different types of structure. So just looking at these common five, I hope you can see that there is no path that says that the right path to scale my company is exclusively venture. The idea that I want you to think about again is that threshold to scale. How much energy will I be spending to be able to achieve my desired result? And how aligned is the funding model to my business objectives? What's the path that I should choose as a company is largely determined by what your goals are as a company. If you're trying to grow to Wall Street, if you're trying to solve a venture scale, a total addressable market that's going to serve the returns of the venture stakeholders that would be investing in your company, then maybe venture is the right path for you. But know that there are pros and cons of each of these different types of entities. The benefit of bootstrapping a company, like the example that I demonstrated about On Its Axis, is that you retain the ownership of your company. If you are able to successfully sell, or you're able to successfully scale your organization by growing your annual recurring revenue, in a bootstrapping instance, as a owner, you have the highest opportunity to create generational wealth from that, because you retain the highest amount of ownership of your company's recurring profit. The downside of bootstrapping is that one, you have to have the wealth to put into the company. So bootstrapping isn't often a path for underrepresented founders. It's also often a slower process to growth. Bootstrapping a company requires a tremendous amount of personal asset risk. You'll hear from some people, I don't know that I subscribe to this model, but some people will share it's always better to risk other people's money. That's one common way to say the risk of bootstrapping is you're risking your own funding on your idea. So that's a note. Crowdfunding of a project has pros and cons to the project. There are many crowdfunding success stories where somebody stands up a crowdfunding. This works particularly well for physical products, for products that have a wide reach in a low per cost price unit. And that's a great example of an opportunity if there's a low user adoption, a low threshold to buy into your product, crowdfunding can be a great success story. But crowdfunding isn't a great model for a venture scale company that has a tremendous amount of upfront cost with a low recurring return, that has a complex sale or a low adoption or a B2B solution. So these are things to think about. Bank loans, and there are countless conversations that you can hear about the pros and cons of being able to access SBA or bank wealth. There are a number of ways that banks have gotten more creative about funding underrepresented founders, funding women, set aside amounts for bank loans. But still, historically, women, the BIPOC community, the Latinx community, they have a lower access to traditional bank-related funding for businesses that they're launching. That's historically demonstrated. So who you are also helps to determine the access and path that you have to take. Something I am personally passionate about changing, but it's a reality of the marketplace. So it's not just what business structure you're pursuing, but it's what access you have as a founder that you bring to the table. And that's an important concept. So I mentioned revenue-based funding is increasingly happening for e-commerce companies, software as a service companies, PaaS companies, creative ways that people are offering recurring revenue founders a new style of funding. It's sort of a bridge debt funding, allowing them access to funds without exchange of equity. Venture capital allows for a infusion of capital that allows idea stage founders with a exceptionally large total addressable market the opportunity to seek funding at idea stage to scale. And that can be incredibly powerful, but it's very limited access because at each stage of venture capital funding received, you're sharing the equity or access to the ownership exit of your company. So in order for you to seek venture capital as a path, your company has to have enough of a market opportunity to pay each of the investors that's going to step in. So let me kind of show what that looks like a little bit on a screen. And this isn't my visual. I want to recognize that I'm a big believer in sort of open space information and not reinventing the wheel. So this will be another link that I share to all of you. Minty Mint, I have no stake in Minty Mint, but they've just done a very nice job of succinctly explaining the startup lifecycle for the venture scale organization. This is a very lovely visual that's accompanied by sort of an A to Z explanation of each of these elements on a simple landing page that I'll be sharing with all of you in the chat at the conclusion of today's conversation. The startup lifecycle for a venture scale company, and I'm going to pause to all of you, and I'm just going to ask, because that was a lot of information that I just shared. if it's clear that a venture scale company has to have a total addressable market, or TAM, that's big enough to pay each of the different investors who are stepping in at each of the stages. So if you have any questions about that, just ping me in the chat. Let me know. Kelly, I'm not sure what in the world you're talking about right now. But this venture scale one, it's the one that we get the most questions about. So at what stage, Kelly, when do I seek venture funding? Should I seek venture funding? The threshold up front about whether or not you should seek venture funding starts with an exercise in appreciating your total addressable market. Do you have an opportunity that will allow you with the go-to-market path that you need to take to go from idea stage to a successful exit, whether that's through acquisition or the public market? And whether that public market, I received a question earlier, should I try to raise in Canada versus the United States? Really, it doesn't matter which public market you're exiting to. There are pros and cons for each of them. What you want to think about is, what's the runway that you need to go from your idea stage, the problem that you're trying to solve, to validating that idea through an MVP or a prototype, to getting market traction, to being able to demonstrate proficiency at scale, to be able to demonstrate recurring revenue at growth. You may have heard this 10x concept. The reason that concept is important is you can exit successfully at any of these stages. It just has to do with what bar you set as the founder, and then each of your investors believes in as you're accepting funding, what bar you're establishing as success. So you can exit as a seed stage company. And that may be successful for you if you're saying that success for me looks like gaining traction and getting my investment back plus $100,000. That can be a barometer for success if you're bootstrapping. And that may be what you want to achieve. And that sets up a path for you. But if your path is to exit through publicly traded market, or your path, in order to be able to develop and work at scale, is going to require a B stage, $100 million funding round, then you need a total addressable market that will sufficiently create returns for each of the investors who are stepping in throughout your life cycle. So you'll notice on here, there's these concepts and working at scale. There's a relationship between the stage of your company and the valuation that an outside investor will necessitate. Now, you may look at this and say, Kelly, I've seen companies get a much higher seed stage valuation than what's listed on this. And that's true. Remember, it comes back to your industry. So data companies right now are getting very high early valuations because of the opportunity that they pose in terms of follow-on investing. Whereas another type of company may have a much lower typical market valuation. So if you're looking at this, remember, you have to look at it from the lens of the problem you're solving in the industry to be able to determine what the typical valuation is for that. Does everybody understand? And you can just give me a thumbs up on your screen. Does everybody understand the relationship between your stage of the organization and the valuation of your particular organization? How companies conceptualize this? You can just add a thumbs up on the screen. Great, I've got some. If you don't, I can spend a little more time on this. So I'm just looking for making sure, because this is a big concept and it's probably the most misunderstood concept out there. When people are asking me, when do I seek funding? And when people are asking me, how do I value my company? How do I think about it? It's a lack of information around this that's probably most confusing. So I'm going to spend a little more time because I only saw a couple of thumbs ups on this. So what I want you to understand that is, as a founder, And I received this from Brad Feld, who I've already called out as being very brilliant and sharing a lot of information. I believe in giving credit to the people who have ideas that I'm learning from. And Brad said you should only take as much money as you need to successfully achieve the next stage. Remember, as you are receiving funding at each of these stages, you should only be seeking outside funding if it helps you to be able to achieve the next stage in your maturity. So moving from idea stage to successfully scaling recurring company to market expansion, right? So this is sort of horizon 2. I've launched a company and now I'm thinking about how to take my successful product to market in different ways, to serve a new audience, to solve another problem that my current audience has, right? You should only be taking money at each of these stages as much as you need to get to that next stage and stay ahead of the competitor, right? Because each time you're taking money, you're reducing your ownership stake in the company. And that's a really important concept for you as the founder. And I want to say that again. Venture funding is incredibly valuable. It is. It allows idea stage founders to be able to create monumental exits. It allows idea stage founders to create world-changing, moonshot ideas that can transform industries because it allows you to operate at pace. It allows you to bring in experts who can help challenge your idea and understanding of the problem that you're solving. It allows for flexibility and growth at speed. But every single time you take a dollar, you're giving away a little bit of your control and your ownership in the company. And so that's the relationship between these pieces. And then the relationship between how venture capitalists choose to fund, if they choose to fund your company, is their belief that they're going to be able to create a return for the people who've invested in them. I'm going to say that again because it's really important. The way that a venture capitalist is determining your valuation as a company has to do with their calculation of your company's ability to create a potential return for the investors who've invested in them. So your venture capitalists who are investing in your company are investing other people's money. Typically, there's a blend of the venture fund's money, some percent, 2%, depending on the fund, maybe more, of their own sort of reinvestment in the fund, if it's a mature fund. But they're taking limited partner money, outside money, typically coming from family offices, high wealth individuals, pension funds. So they're actually taking stock market money and putting it back into funding. They're taking other corporations' money. So Google and Amazon have ventures. They're taking all of the money that other companies have created and institutional wealth that's been created, and then they're reinvesting it in seed stage funds. And they have to outpace the secure investments they could get on the market. And that's a lot of information, but it's a really important concept. So as you're seeking funding, the thing to remember is that each stage as you're seeking this funding has to do with your maturity as an organization. It has to do with the belief in the people who have the money that your company can create value for the people investing in them. So it's a very collective and collaborative ecosystem. And when you understand that, you can unlock raise. So if you're looking at, Kelly, how do I raise? The answer is show the venture funders why you have a unique selling proposition that will let them capture a return, because that's what's really important to them. So when you truly understand the pain point you're solving, how it's uniquely positioned in the market, and how your program can create a return for their limited partners, their LPs, and you can convey that, you will differentiate. And that's a really, really important concept. All right, I spent a ton of time there but it's a really important one. So I'm going to pause as we go to the next one. I'm just going to take a quick look at chat. And I'm seeing a question that came into chat, and this is actually one I get all the time. Do I watch Shark Tank? I have to admit, I don't watch Shark Tank. Shark Tank is one that it's like people who are chefs don't often spend a ton of time eating in their own restaurant. I find myself when I am consuming content, sort of to decompress, I try not to do it on things that get me more excited about the work that I'm already doing. So you may wonder about my passion for this. You may feel my passion for this. I could spend all of my time working and talking in this space. But shows like Shark Tank, I'm very familiar with the model. I think what's wonderful about shows like Shark Tank is that they do help people to understand the basic concepts of pitch, valuation, funding requests. They help people to understand the why. You know, there's so often a disconnect between the founder's valuation of a company and the venture capitalist valuation of a company. And it's not, and this is the most important thing I think Shark Tank helps people to understand. It's not about the value of your product. Your product might be solving a really important problem, but it is about how that value can generate a return. And that's the element you need to think about. Founders who understand how to figure out how to solve a problem in a way that can create returns for venture capitalists, really the ones that can secure funding. So what I think is value about Shark Tank is that it shows why there's often a disconnect in the deal size between what the person who's asking for funding thinks they should be able to get and what the sharks are willing to invest. The other thing I think is really important is that even venture capitalists who try to value companies all day don't have 100% return on the ventures that they invest in. The ventures that venture capitalists invest in are chances, they're bets. And they're trying to create a portfolio of bets that are going to create returns for the organizations. So that's a really important piece. I think the element of Shark Tank that is important is you have to truly understand your business, and you have to truly understand the relationship between the problem you're solving and not just your approach to it, but what the general market, who your target buyers are, what their general approach is, and really understand that not investing in your company has very little to do with the importance of the problem you're solving or even your approach to solve it. It has everything to do with scale and the opportunity for scale. So a venture capitalist versus a VC is another question that I just got. An angel versus a VC is another question I just got. An angel is often engaged. Typically, they're going to invest in things that they're also passionate about solving the problem for. So what I like to say is angels are much more like nonprofit donors than venture capitalists. So a venture capitalist is akin to the foundation in the nonprofit space. A foundation is going to have a grant process. There's going to be a very significant burden on the part of the nonprofit to be able to demonstrate solvency as an organization, sustainability, impact. The donor is typically going to donate because they believe in the opportunity. And so just as we sort of wrap up our time together today, I just really want to encourage all of you to think about the path and the fit. The way that you're going to structure your company has to do with, are there enough people who are solving, who care about my problem to help me get from my idea to something that's scalable at pace, that allows a venture capitalist to be able to invest in it. Because early money is the most expensive money. If you take money from outside resource at idea stage, you're sacrificing the highest upside of your company. So really spending time thinking about, can I get conviction from other people and buy-in from other people on my idea in order to be able to scale, is going to help you achieve results. The other thing that's going to be really important is to get flexible about how you solve the problem. How you solve the problem as an individual based on your use case and the experience that brought you to the startup may look very different as you expand out to the total addressable market that outside investors are going to look for you to serve. So remember to stay aligned to the importance of the problem you're solving, but be flexible about the approach to solve it. And you're going to have the greatest opportunity to be able to receive funding and to receive funding at a fair market valuation. We've reached the end of sort of our normal time together. And so I really want to thank everybody for attending today. And I want to give all of you who stayed on the line an opportunity to stay on. So I'll let Brian close up on our traditional close, and then I'll stay, since some of you are asking key questions, for an additional 15 minutes in a Q&A session if anybody has follow-on questions. Brian, over to you.
Thank you. Well, that was such an amazing session. I see everyone, needs some more time to engage. So yes, feel free to stay afterwards too. But just to close it up for those who are leaving, I just sent out on the chat a feedback form, and we really appreciate if you can fill out that feedback form for us. And also, again, the video will be recorded and then uploaded onto our YouTube channel. So stay tuned for that and follow our social channels.